how to stop losing money in the stock market. What is happening, investors? It is your boy Jack. I am not a financial advisor, and today we're going to be speaking about the psychology behind long-term investing. I think that a lot of us who get involved in the stock market in the first place plan on being long-term investors. I also think that a lot of people who watch this channel, okay, haven't even been in the market for a year, myself included. We haven't lived through as many market cycles, as many crashes. We haven't lived through what a lot of the veterans have, and I know there's a lot of the veterans on the channel as well. They'll be able to attest to this. It's like anything in the life. The more you get exposure to something, the more you will be able to adapt. So if you're in the market for less than a year, and now you're seeing this massive market crash, it could mess with your psychology. Because of that, we may begin to question ourselves, or our abilities, or our choices inside of the stock market. And that's all part of the process. That is all normal. Everybody will make mistakes, okay? Everybody will more than likely panic sell at some stage. Everybody will make a poor buying decision. But we have to learn lessons from those mistakes. So today, I want to speak about the psychology behind my investment thesis, behind my long-term investment thought process. Because I know now in particular, there's more people worried. The UK just officially entered recession. The market is doing some weird things. We've seen some major pullbacks on some very, very popular stocks as of late. And I know that in general, just from reading my comment section and from reading my Instagram DMs, there's a little bit more panic in the market than there has been the last few weeks. Right before we get into the information, guys, can I please ask you to smash a juicy like, as it helps me and the channel out so much. I really would appreciate it. If you're new around here, please hit that juicy red subscribe button. Join the family, people. We are growing quickly. I appreciate every single one of you. And please do drop me a comment down below. Let me know if you have any tips for long-term investors as well. I feel like we can really help each other out in this video. So let's just remind ourselves from the start of today's video, we are long-term investors, okay? Now let's get into what I really believe that means and that entails. The very first thing I want to speak about today, okay, is the fact that long-term investing, guys, it isn't very exciting. What's way more exciting is getting involved in, a brand new startup company or options trading. What long-term investing is, it's a safer option over a long period of time, The S&P 500 on the 6-month chart, okay, is up 0.19%. I mean, guys, people make 100% on a day doing options trades on pretty much any stock. On the 1-year chart, up 15.5%, people. If you invested exactly 1 year ago, did not touch that money whatsoever, it would be up 15.5%. On the 5-year chart, 61.62%, people. It is not exciting. This is not where you go to get a thrill. This is not gambling. So let's get that concept that long-term investing has to be exciting out of our heads from the start, because it really doesn't. If you're trying to set yourself up for an early retirement, it doesn't need to be that exciting. What I will say is the longer that you stay invested, the more likely it is you are going to make money. This is why I get frustrated sometimes. I'm in a unique position, okay? I'm a long-term investor. I do, however, put a considerable amount of my money into startups or growth stocks, whatever you want to call them. And oftentimes, in the short term, these companies go down, because that's what happens with growth stocks. That's even what happens with long-term investing a lot of the time. If you make an investment that goes down 10% overnight, nobody knows. If I do, literally thousands and thousands of people know. And I've stopped letting this get to me, because I don't personally think you can judge a long-term investor on their investments if they haven't even been in the market for 10-20 years. It doesn't make sense to me. You wouldn't base somebody's skills on being a doctor on their test results in their first year of college. That's not how it works. The same goes for long-term investing, guys, simply put. Remember when I bought Tesla, okay? I was one of the people who bought Tesla at all-time highs, okay? $1,700 a share. Literally the next day, I think we lost like 10% of value. And I got a lot of criticism for that. I got a lot of people in the comments making fun of me, etc, etc. I'm gonna hold Tesla for decades, okay? It was fine. It was absolutely fine. I'm not worried about it. If Tesla goes down to $900 a share, $800 a share, again, I genuinely will not be worried about it. And that is because I do have a strong mentality and a strong psychological outlook when it comes to long-term investing. And that is going to bring me on to my next point. Tesla is going to offer us a fantastic chart to look at here. If you are a long-term investor, do not listen to short-term investors. Do not listen to people playing options calls. They are completely different. You and them are apples to oranges. If you are long-term on Tesla, okay, And even if you buy at $1,500 a share, very near all-time highs. If somebody says that's crazy, okay, it's definitely going to go down over the next 3 days. I'm going to short this stock, or I'm going to take put options on this stock, whatever it is. They are thinking about 3 days. You should be thinking about 3 decades. You cannot compare yourself with those investors. And that can be hard, especially if you're a new investor, okay? Which again, I am. But a lot of new investors don't realize just how slow it can be starting off in the stock market. And you see this person who made 200% on one options call last night. That looks a lot more exciting. What they don't share is all of the losses. If you are a long-term investor, what happens on a daily, weekly basis does not matter. Again, for me, I was one of the silly people who bought, you can't even see what price I bought Tesla on. That's how high I bought it, okay? It was an intraday high and it closed down already like 5%. Since then, it's come down, okay? Down over 10%. Now, yesterday it did go up a nice 13%, so I'm not down as much. But again, I'm not worried about having bought up here because I ultimately believe it is going to go up. You can say that, oh, you should have waited a day, you should have waited a day. I was waiting a day down here. I was waiting a day down here. I was waiting a day down here. If nothing else, Tesla taught me massive lessons that if you believe in a company, you buy. So basically, don't ever compare yourself to somebody with a short-term mindset. Not that there's anything wrong with a short-term mindset, it's just two completely different things. Okay, we can just stick with Tesla here, okay? What happens to a company on a daily basis doesn't matter to you. After they hit their all-time high of 1700 and drop back down and continue dropping back down all the way to, where were we? In the 1300s. It doesn't really matter to you. It should be that simple. Because again, guys, bringing it back to what I just said, if you're holding it for decades, are you really going to remember those 3 days where for a period of time you were down 15%? If you're up hundreds and hundreds and hundreds of percents, no, you're not going to be worried about that. Like NIO, for example, when we had the fantastic quarterly earnings, okay, but the market decided, you know what, you're going down. We were up over 9% pre-market. We closed the day down about 8.5%. Traditionally, that doesn't make sense, but sometimes that's the way it goes. A lot of people ran away, took some profits, then a lot of people saw the market was coming down, so they decided to sell, despite the fact there was nothing but good news. So again, this is where it comes to always thinking for yourself, people. You know, if you did the research, if you looked at those Q2 earnings, if you were already invested in NIO before those earnings, nothing got worse. If anything, fundamentals only got better. I'll give you another example with one of my favorite companies, Facebook, okay? Remember the ad boycotts? They dropped 8.32%. I'm fairly sure they were down more than 10% intraday. The boycott scared a lot of people, okay? Simply put, a lot of people sold off based on this information. What did I do? Facebook's a company I've done a lot of research into. I absolutely love them, and I bought more. Down 10%. I actually got in below that $216 price point. And since then, where are we? Whatever I bought is up over 20%, okay? And that's just from the 26th of June. If you invest in Facebook with the intent of holding them for 20 or 30 years, okay, and you see this very short-term issue that will more than likely be over within a few weeks, maybe a month or two, that's your time to take advantage. That's your time to buy more stocks. And again, were you a bad investor if you bought here before this crash that nobody could have foreseen happened? No. And again, if you just held, again, you're already up in the green. What I'm really getting at, people, is that what happens on an intraday basis should not matter. Okay, the next thing is, you don't have to sell a company because they're in the red. It really is that simple. Wells Fargo, a company a lot of you are probably aware with, has been absolutely smashed to pieces. I mean, they're still down nearly 50%, and that is genuinely after going up quite a bit on the 5-day chart, okay, at their peaks over 7%. I'm a buyer of this company. I was down like 30% in this company. I had very few shares, so thankfully I was able to dollar cost average. Now I'm not down near as much. But the point is that just because a company goes red does not mean you have to sell. We are all going to get bad entry points at some stage or another, especially in the times we live in now. A lot of us just started investing. A lot of us started investing in February and March when the crash was at its peaks, people. We would have saw red days. I know when I started investing, there was a stage where my portfolio was over 25% in the red. I've said this in videos before. I genuinely was. Within like a month or so, I was 25% in the red. Now, thankfully, I had literally maybe $1,000 in the market, so it was very easy to dollar cost average, I'll put it that way. The important thing is, I didn't sell any of those companies at a loss. I was down 25%, yes, but I brought that all the way back up to the green. If a company is in the red and you sell it, that is a realized loss. You did lose money. If a company is in the red and you don't sell it, that is an unrealized loss and you haven't actually lost any money. You only lose money when you sell. So for example, when I did my research into Wells Fargo, okay, I believed that ultimately it would go up in value over the long term. I also understand that it could take a couple of years for any sort of very meaningful recovery to happen, but I do think that when that recovery happens, it will be very aggressive. Go back to the very bottom of the Great Recession, okay? And they went on an absolutely disgusting bull run. This is a bank stock, okay? And in less than 10 years, they were up over 500%. That is not something that generally happens. All the time as well, they were paying an absolutely massive dividend. When economies do well, bank stocks do well. It's that simple. When economies do poor, bank stocks do very, very poor. This is just another case of due diligence and being willing to hold even when things don't go your way, when things don't go as planned. This should also be an example of why you shouldn't put all of your eggs in one basket. If all of my money was in Wells Fargo, boom, that would have been game over. This is also why I personally like dollar cost averaging, because if I just bought Wells Fargo once, I'd still be down maybe 30 or 35% even. But since I didn't, since I was able to dollar cost average, I'm down less than 15%. And I quite easily could make that less than 5% if I really wanted to. So long-term investors should not have all of their money tied up in one sector. Now, it does get a little bit complicated here because every investor is different, okay? Me personally, I'm a young investor. I'm aggressive. I am absolutely fine with being in the red. I am absolutely fine with having unrealized losses for a while. I have about 65% of my portfolio in tech stocks and growth stocks, and my growth stocks are pretty much EV stocks, which are pretty much tech stocks. So I have a lot of money in one sector, but the rest of my money is spread out in different sectors. We have some utilities, we have banks, consumer discretionary, consumer staple, most of which pay dividends. So when things are going bad for tech, as they did the last few days, except yesterday, which was a very good day, the other sectors can keep me up. A lot of people have this misconception in their head, okay, that growth stocks have to be short-term investments, and simply put, that is not the case. With Workhorse, for example, which is the biggest position in my portfolio, I plan on holding this company for a long time. I really do, people. Growth stocks don't have to be short-term investments, okay? They can be, especially things like SPACs. You know, we've seen people like Nikola go public and go up hundreds of percent, and people sell and it comes crashing back down, etc, etc. But they don't have to be short-term investments. If we look at Apple, for example, okay, when this went public, it wasn't a well-established company, okay? It was not the company that it is today by any means whatsoever. It would have been a growth stock. And I think it went public at about $20 a share. When you take all of the stock splits into account, it was essentially 51 cents a share. If you had have invested there, okay, within 10 years, you would have been up 174%. That's absolutely fine. That's a decent return, okay? But if you had have held for a very long time, if you had have held for 40 years, you were up 88,500%. I want to bring you all back to Workhorse, okay? Because you may remember this spike here where we went up 25%. I got so many people asking me, did I take profits, okay? Did I sell? Did I run away? And the simple answer was no, not at all, people. You know why? Because I am not interested in a 25% return. I am interested in hundreds and hundreds, if not thousands of percents return. Now, that's not going to happen with every growth stock you ever choose. A lot of the time, you will get away with just a little bit of profit, or maybe a small loss. But when I'm investing in a growth stock, I'm doing so with the intention of getting a massive return on it. So having a certain amount of your money in these more speculative stocks, okay, can make things more exciting, can make long-term investing more exciting. And do just remember, I'm 22 years old, I have a very high risk tolerance, okay? If things go wrong for me, it's fine. If you're a more conservative investor, or if you're a little bit older, it would more than likely make a lot more sense for you to have your portfolio laid out very differently to how mine is. I've said this in previous videos, but when I am getting ready for retirement, I plan on having the majority of my money in dividend paying companies. Until then though, I want to go aggressive and make as much money on these growth stocks as possible. But I just want to say that just because you are a long-term investor doesn't mean you have to stay away from growth stocks. Maybe don't put too much money into them, but you don't have to stay away. Honestly guys, there's a few main points that I want you to take away from this video. One is that you should believe in yourself and the investments you make. This is why I so heavily preach on the channel that you need to do your own due diligence before deciding to buy a company, because so often in my comment section I get people asking me what I think a good price to buy is, or if I think they should be selling, and I always tell them I don't answer those questions. Only you can decide that. It does not matter what I believe or what I'm doing. Only you can decide that information. Because if I just tell you, okay, and the stock goes down 10%, you're not going to have any idea what you should do. You won't be able to think for yourself. You won't know if you should sell or if you should buy more. And what will happen most of the time is people will become afraid and they will sell, and then they'll see 3 months later it's back up 50% and be like, why did I sell? So form your own thoughts and opinions. That is rule number 1. Rule number 2, don't be emotional. Now, we're all humans. We all have emotions, and no matter how many times we say that saying, emotion will come into play. But try to control your emotion when it comes to both buying and selling. And this goes for when things are going good and when things are going bad. I've gotten a lot of comments as well from people speaking about Tesla. Okay, a lot of people got in at $300 and sold at $400 because they got emotional, they got scared, and they took their money. I've also gotten it with Tesla the other way, where people may have bought at $600-700, saw it go all the way back down towards $400 and sell. This is where being a long-term investor really comes into play, people. And as I've already said in this video, just because a company goes down 20 or even 30% in value doesn't necessarily mean you have to sell. Now again, sometimes it does mean you should sell, but it doesn't mean you have to. Just remember what being a long-term investor entails, people, and you will find yourself stressing a whole lot less. So guys, there we have it. I really do hope I was able to, give you some reaffirmance today, or I was able to give you some tips on how to become a better long-term investor, because I know that when you start seeing companies go in the red for the first time, it can be scary. I do remember it happening with me, and I was so often tempted to sell out of some of these companies because I really began to doubt myself, especially as a new investor. But I did hold, and literally all of those companies are in a better position now than where they once were. I won't say they're all in the green, but they're in a better position. Hopefully you did enjoy and I was able to give you some value though, guys. If you did, please do hit that juicy like button, as it genuinely helps me out so much. Guys, please subscribe if you're not yet. I have 2 absolutely insanely exciting videos coming out. One is out Friday tomorrow, one is out Saturday, and I'll just say there's 2 special guests coming onto the channel. I won't give any more information than that. And if you haven't yet, guys, please do click the first link in my description box. Check out my merch. The support on this merch drop has been crazy. I appreciate you all so much. With that being said, guys, I hope you all have an absolutely fantastic day. I will see you for tomorrow's video. Peace.